Hello and welcome to the next edition of Fridays with Fintelekt. My name is Shirish Pathak. I head Fintelekt Advisory Services. And for those of you who don't know what we do, we are focused on research, training, and advisory in anti-money laundering and countering terrorist financing. Today's discussion is centered around the AML CFT risks in digital banking. And my guest today is Jonathan Rogerson, who currently heads the APAC South business and strategy at Accuity, which gives him a bird's eye view of what is happening in the digital banking landscape across the region. Johnny is originally from the UK with early experience of working in police intelligence, after which he spent more than 10 years across Asia working in compliance, AML, credit, and sovereignties. Johnny, welcome to this session of Fridays with Fintelekt. Johnny, to start with, why are we seeing so many digital banks cropping up in the region?
Yeah, so first of all, Shirish, thank you very much for the invitation to be here today. Have a good chat with you. Definitely appreciate it. Love the fact that we're joining Fintelekt again. In terms of your first question, why are we seeing so many digital banks cropping up across the region? I would say that, digital banking, and especially in Asia, this is not a new trend. But I would say it's definitely one that is becoming more and more of a theme in more recent years, where we're seeing much more of a push from even governments and regulators in certain markets to really try and promote some of these digital bank organizations. But there were very early adopters already in the region. I mean, we had in China and even Korea a number of years back, originally some digital banks, in Korea, we had the example of Kakao, for example. And I would say that is an example of the trend we're seeing now, where they were never even a financial services provider. Originally, they were a chat platform, so it was a digital channel, one that was heavily used with over 40 million customers on that chat, or social channel at the time. And when they actually, became a digital bank in Korea, and pivoting to actually providing the financial services, etc., they actually engaged and actually onboarded 1 million customers within the first 5 days, really tapping into that, population of users already as part of their chat platform. Now, what does that show us? I would say, that's definitely evolved even more so across the region now. And I'd say that it's a couple of things. Firstly, Asia Pacific as a region is very technologically savvy. And when I say that, I'm talking about, the likes of you, me, and everyone else. There's a great adoption from, consumers to use digital channels. That's been definitely the case in e-commerce. Now even more so on social media and various channels associated with that, and also the traditional internet. What was then further accelerating that, and not just in Asia, it's really about the mobile phone, right, and smartphones in particular. I think now globally there's more mobile subscriptions with internet capable mobile phones than there is actually humans on the planet. So I think now it sits at around nearly 9 billion such mobile phones in the world, with a population just over 7 billion. So that's really driven a lot of, further adoption of these digital channels. I mean, 65 to 70% of all internet traffic in Asia comes from smartphones alone. So that's where we've really seen examples like that Kakao and other companies. Some major fintechs have been grown in Asia, names like Alipay, Grab, WeChat. These are now global leaders in what they do. And originally, again, they weren't financial services providers. Alipay, etc., for example, again, they were chat platforms, WeChat. But now, you look at China, digital payments in China account for around 99% of non-cash transactions. So they've seen a massive shift to, a cashless society, further adoption of digital channels. And that's really, challenged a lot of the traditional banking in the way we maybe thought about it before, where it's really a traditional bricks and mortar approach with your branches and very old established institutions. Those fintechs have essentially become tech fins now, and they've really managed to do that because, first and foremost, they're driven by data. They have huge amounts of data from their customers. They know things from that data, from analytics, etc., where it's really around behavioral trends with their customers. And what that means is that digital banks have really pushed to the forefront of being all about the customer. They're potentially able to provide cheaper products, more tailored solutions, better offers, more innovative products, not just cutting across your deposit taking accounts, etc., but also lifestyle and things like this. So, digital banking promises a lot more than some of the traditional banking. And then, even alongside that, you've got some of the fundamentals where in a lot of markets in Asia, there's a lot of populations in rural or areas where we would maybe have less adoption of banking, right? And that's your kind of unbanked populations. And if you even look again away from retail, where we think about you and me and those kind of unbanked, and even, you look at the example in Singapore right now with the 5 digital banking licenses that are up for grabs. I mean, 3 of those have been defined as being for SMEs. The government regulators want to actually provide better services in the same way that we've seen, in digital channels for the retail consumer, but also for SMEs, right? Where there's a lot more integration, potentially adoption, and better streams and more creative streams of financing and all of these different areas that SMEs and corporates require, right? So the unbanked is also in that space too. So it's becoming very competitive. But again, it's because banking in Asia is a huge industry. 40 of the world's 100 largest banks by asset are in the region. There's been a huge amount of growth even in the last decade in terms of banking. Yes, it might have dropped off from double digits in the last 4 to 5 years, but that as well as why we're seeing a huge push from digital banking to really meet some of those requirements now from consumers and also from the markets themselves in terms of adoption of digital.
Thanks, Johnny. What would you say are the specific AML CFT risks that are emerging due to the shift to digital banking, especially as customers in this space are likely to have no face-to-face contact with the bank?
Yes. So when you mention, what are some of the specific AML risks, especially that might be emerging due to the shift to digital banking, I'd say that it's not necessarily that there's new risks being created here, but maybe some of the risks in certain areas are a bit more amplified, and of course, the way that they manage risk is also very different. So you mentioned, yourself in the question, digital banking, the nature of that, the whole point of that is that it doesn't exist like in a traditional bank. It doesn't have branches. It doesn't have that physical face-to-face contact. Now, at the same time, though, they have the same requirements as any other authorized institution, regulatory requirements, etc., around the checks that they have to do with their customers. So I would say from our experience, when we work with pure digital banks themselves, and we have some customers in the region that are fully digital banks, what we've seen is there is absolutely a strong reliance on the customer onboarding process at the front end of the customer journey. Maybe perhaps unlike traditional banks, there's a lot more investment there, specifically as part of that process, and especially on technology, because they are branchless and because they're doing this remotely. So when I would normally have to open a bank account in years gone by, you'd go in, you'd bring maybe your passport, maybe some utility bill to prove your address, etc., and you'd hand that over at the teller, and that would be done face to face. The same is done, but in remotely, that first part of that onboarding KYC would really be around that ID verification. Is this person who they say they are? So to do that, technology has definitely massively supported that process, where techniques like machine learning, artificial intelligence, etc., are being utilized to even validate whether that is actually a real ID, even if it's a picture of an ID or not. And then, as a second layer to that, once maybe they actually validate that ID is a real ID and this person is the person, it's really then doing a second layer of check, maybe where we bring in some biometric checks to then validate that person alongside the actual snapshot of the ID. So, you know, those are kind of things that are really baked into that onboarding process, even at the ID verification level. And technology is a massive part of being able to do that for digital banks. Once they've still confirmed who these people are and confirmed their identity, etc., again, you know, when it comes to AML, etc., there's still further customer due diligence that's required to really see more about this person. Are these persons that are potentially a risk to our organizations? Should we actually be onboarding them in the first place? And that's where you see further checks being done on those people, their associates, etc. And that would feed into then the digital bank's risk-based approach. If this is somebody that would maybe expose some risk, or is this a very high risk, or is this absolutely a no-go? So the same risk-based approach would apply, and they would have their own risk-based approach in place. But what I'd say when it comes to digital banking, there's a bit of a challenge in that, you know, the customer expects a very quick process with any of the services that are being delivered by a digital bank. That's where they're also uniquely competing with some traditional banks. So there is, you know, weighing up that risk versus speed appetite, again, even on the customer journey. So for digital banks, it's of paramount importance that they don't neglect this process, because once they onboard a customer, that's where actually they can do a lot more with that customer. But to make that process a little bit quicker, this is where, you know, we're seeing almost like, you know, a digital KYC utility internally within the bank. And what does that maybe mean? I would say, you know, it means that there's a lot more integration through APIs and specific architecture that's set up in a way to help this, where they can really tap into data from multiple business lines, potentially multiple jurisdictions, as part of that actual KYC process. You know, that will allow information to be grabbed, to be checked in a much more timely fashion and a more efficient fashion. It's also where we're seeing maybe in these organizations that then that KYC journey isn't a point in time where, you know, you might say, I'm going to do a recheck of this person a year, 2 years, 3 years based on the risk-based approach when they were first onboarded. You know, it's really more around event-driven KYC, where they're continuously essentially being validated. Are there any changes to this person's circumstances, etc.? So it is much more event-driven. It means that at any point in time when it comes to actual business with that customer, they're really at a more up-to-date point in terms of understanding that customer. And that really allows a much faster STP, which is what digital banks want. They want a straight-through processing at 100% in a lot of areas of what they do for the customer.
So what would you say are the considerations for digital banks while performing screening, especially as transactions are real-time?
Yeah, so when it comes to digital banks and performing screening specifically on transactions, you know, as an organization, something that we talk a lot about with our customers is, you know, some of the 3 key pillars when it comes to the process around AML and sanctions. And we talk about people, process, and technology. I would say in this area, I'm going to be bold, specifically around screening on payment transactions. You would not have a hope of complying if it was done without technology. And I say that having also had, you know, the same view shared with us from some SEC heads themselves that we work with in many organizations, because the reason for that is the sheer volume of payments and digital payments, you know, in this region and globally in the past years that have actually exploded. And look, why is that? Is that because of digital banking alone? No, it's not just because of digital banks. There are a huge number of payment service providers out there that have already disrupted the payment space and have really challenged banks on cross-border remittances. I myself have been in Singapore for 10 years. I actually am from the UK, but I still need to send money home back to the UK for various bills and things that I still are required to pay. And I have definitely not used my own traditional bank here in Singapore for a cross-border remittance back to the UK in at least 7 years. And the service that I've been using for many years now is a fully digital service. I was onboarded digitally. I've never met anyone from that organization, never been to a branch. But you know, the service met my requirements as a consumer. It was very transparent on the fees. It was also low cost on fees. It's also super fast and also very transparent even in the process of the actual payment and receiving of payment. So there's been a huge explosion there in the digitization of payments first and foremost, and that explosion has really brought about vast volume increase in payments. Now, what does that mean when it comes to, you know, screening of transactions, and especially because these instant payments, like you say, being real time, many now need to be processed within a second or milliseconds, you know, not minutes or even days as once they maybe would have been able to do. That comes back also to the consumer and their expectation. If I'm a traditional bank, I know that I have challenges out there that are actually providing these kind of services. So as a traditional bank, I also need to be able to meet that customer expectation or potentially risk losing that customer for remittance, which is a huge part of the book of business of any financial institution, these transactions. Now, inevitably, and this is an area that we, you know, hugely support in terms of our solutions, inevitably what that does is it actually shortens the cycle for screening itself. So when that transaction happens, you know, there's a window there for screening. Now, because the transaction is a much quicker expectation, it has to be done instantly. That then leaves, as a result of that shortened screening cycle, it leaves subsequently a much smaller window for review of the actual alerts that come out of the screening. So, you know, many of us are all aware who work in this space, you know, sanction screening on payments, for example. It's really just certain specific fields within a payment message that are then essentially screened against and checked against various reference data points as part of watch lists, enforcement lists, etc. But what comes out of that as a byproduct is these alerts, these potential matches. And first and foremost, the financial institution, what they're trying to do, digital bank or not, they're trying to find the ones that are a true match, right? This is actually a transaction that we should not allow to happen for a reason associated potentially with a sanctioned entity. That's the ones they want to detect. However, the way that things have been built, even in some of our own technology, because the volumes and also the speed expectation of those volumes was vastly different a number of years back. The challenge there is that it's almost a needle in a haystack approach. And people or reviewers in financial institutions are going through huge amount of volume of low quality alerts to try and find that one that really stands out. That's where I'd say that when it comes to, you know, screening of transactions, digital banks themselves are in, again, maybe an enviable position, right? Just like they are disrupting the traditional banking models and structures, they themselves, and I mentioned it earlier, a lot of their technology and architecture are being built from the ground up as new players into the market, as new banks, essentially. But what that allows them to do right at the start of this journey, and what, you know, potentially to recommend when it comes to transactions, is make sure that they have technology that is really scalable. Of course, they might not have the transaction volume initially when they come online, but as they start to grow in the ways that they foresee they will grow, which many digital banks have strong aspirations to do, naturally those remittances, whether it's cross-border or domestic, are going to vastly increase if the business model works out. And that's where they can actually start to bring in some of those next generation solutions and technologies, even likes of some of which we provide, into their process now today from the very start. It means that when those volumes start to come in, they can potentially handle those volumes in a much more effective manner. So where previously, it's been very much rules-based, driven screening systems, even our own systems previously in this space, there is more of a shift to, not just being rules-based, but looking at machine learning, artificial intelligence, advanced analytic techniques on top of that. And something that we're really trying to help organizations do in this space and are doing is really, as those alerts come out, it's really a check against what is the probability of this being a true match, and what is the potential severity of this match. When you actually do that, it allows for these organizations to have a much better view of those alerts and really prioritize alerts and see the alerts that they want to see in these review teams at the front end. So they'll be able to see first and foremost that 1% of alerts that are most likely a true match, highest probability and highest severity. They can immediately go into those alerts and start to action those. And that's what really they're there to do, not actually to find and confirm false positives. Now, there's been a number of years though where that's been happening and huge teams have been built up to do those review exercises. And that's where we're really trying to help with that pivot, which is being driven by some of those market dynamics, driven by the digitalization of payments as a whole, driven even more so by digital banks and, some of the competitive edges that they're trying to bring to consumers. And also as an expectation, like myself, as a consumer, we have. So I'd say the whole industry is moving here, and technology is a key linchpin on that. But, without, forgetting some of the other aspects, like I mentioned, of those three pillars, of course, people and process are still vastly important. No one technology solution can handle it from end to end as a process. So some things that we also encourage with many of our customers is things around system validation, specifically on transaction screening. Many organizations often do over screening where maybe they're doing too many reference lists, and what that does is again amplifies the low quality, high volume of false positive alerts that come out. So really it's about spending the time to map that process, validate that process, and make sure that the screening is being done against only the required reference data that you need to do that against. Additionally, also, we've seen instances where sometimes new technologies have been brought in some organizations and they promised a lot, but what's then happened is that it's been very much a proprietary black box in terms of any model or algorithm, and it's not been explainable. And that's been no good for, banking institutions, and it won't be moving forward anyway because, regulators themselves expect a huge amount of explainability in terms of look back exercises and understanding why things were approved, not approved, etc. And then, outside of that, it's just maintenance of the process of the technology. So testing and tuning is a key, of key importance in this area for banks and digital banks. And coming back to the data point, which is really important in all of this digital space, some things that are really good to do are data integrity audits within banks. I mean, if we look at the organization, a lot of these payments will first come from an in-house payment system, and then you'll also have another system, potentially like ours, where there's watch list data and screening that's going to take place against that. So you're pulling data, or organizations are pulling data from different places. It's important that the banks, the organizations themselves, do those data integrity audits quite regularly and make sure that these systems are well lined up, and also check for any inconsistencies in that data. And finally, and really the fundamental level, it's really key to map again the process. What are you trying to do when it comes to transaction screening? The technology is one part, but also within that process, you really need to map and identify those critical data fields, the fields that would be recommended that you screen against. And these are not a huge amount of fields, but it's imperative that they're mapped to each type of payment, each structure of payment, etc. So there's a lot that goes into this, and it's only going to increase because of these volumes, which keep increasing in terms of digital payments, and especially around also the risk element with regulatory requirements around sanctions linked to transactions as well.
So, Johnny, compliance costs globally are increasing, while digital banks must keep operational costs low to ensure greater competitiveness and a better balance sheet. So, how can these contradictory issues be addressed?
So yeah, Shirish, compliance costs globally have been increasing, and they have been increasing over the last decade or so. I think first and foremost, that's come off the raft of regulations that have come out globally. The global financial crisis in 2008, that really spurred a lot of new regulatory requirements, events like 9/11. These are things that really maybe spurred some of this increased regulation on banking institutions, financial institutions. But first and foremost, it's good to remember that the why behind those regulations, especially in the area that we help support our customers and provide solutions to combat. It's really around some of the financial crimes on money laundering, terrorist financing, sanctions, and evasion of sanctions, etc. These are really important areas to tackle, and that's where it's important for organizations and to remember the why behind these regulations and the outcomes that they're trying to work towards. I know you talk about it a lot, Shirish, in some of the forums that you are part of, where compliance professionals are really the financial foot soldiers, so to speak, at the front line, that are really trying to prevent these illicit money flows from certain illicit trades to come into the financial system. So that's why that's happened, but with the increase in regulations, of course, that's meant there's much bigger compliance teams, much bigger review teams as part of screening and checks that are going on. So yes, that increase in these compliance areas has increased that cost. And traditionally, banks and things see that as a cost center and not something that is necessarily having an impact on the bottom line when it comes to actually business and revenue generation. Now, what I'd say is, though, that cost of non-compliance, we've all heard it, and I've shared it many times before, is potentially far, far greater than the cost of compliance. On the back of the regulations, there's been a huge amount of enforcement as well globally, with some multi-billion-dollar fines in some instances being implemented, and that's starting to spread across into the corporate and non-banking financial institution space as well. And as part of that, there's the huge brand impact and the reputational impact. Often, those impacts are far greater than the actual dollar fine in and of themselves. Major banking institutions, with the raft of regulations, it is what it is, but they have in some ways also, budgeted for these times where sometimes compliance doesn't meet expectation, and there are some of these slip-ups, and they budget accordingly for those slip-ups. But the reputational damage goes far beyond that point. And for a new bank, especially a digital bank, that reputational damage and potential financial damage in terms of any fine can be hugely debilitating. In early years of that growth of those businesses, where profitability is maybe not even there, and that capitalization is far less behind that poses a massive risk to them. So you then see that actually they need to take it seriously. They are taking it seriously, and the regulation doesn't keep them out of this compared to traditional banks. However, as you mentioned, the operational costs and trying to ensure greater competitiveness, this is where we're seeing more and more and more, especially in the compliance field and the solutions that we're even providing within that. Honestly, there is now a view of potential return on investment and how it actually is seen an investment that can help on the even bottom line, right? If we think about what we just discussed in some of the questions you already asked, Shirish, digital banking has emerged and is growing and is accelerating in more markets because of this requirement from consumers to have more choice, have better costs, have more innovative products, etc., and also have the speed to delivery of those services. And so in and of itself, it's important that these digital banks invest in the right processes, invest in the right technology, and invest in the right setups from the beginning. that's where for digital banks themselves, they're really having to, look at how they have their architecture set up, and what they're doing differently to, the traditional incumbent banks, which are trying to now do this, is really exposing logics via APIs across a number of areas, a number of jurisdictions. And what that allows them to do is have seamless integration with other parties and other systems. And that will ultimately, even when it comes back to the compliance part of the business and the checks they need to do as part of customer onboarding and ongoing checks as part of those KYC and due diligence, and also on the transaction screening that we've talked about earlier. That's where in the first instance of that journey, and what we've managed to do and what we see as a key importance to digital banks is really being able to work with partners, RegTech partners that actually can, scale with them and partner their growth journey. So what do I mean by that? Obviously, when a new digital bank first comes online, they don't have any customers. They don't have the volume of transactions in place at that point in time. However, they often more than not have very aggressive and competitive growth targets in all these areas of customer onboarding and then moving into transactions, which is a huge part of the business moving forward in terms of revenue. But in that first instance of that journey, they don't need a solution or technology stack in place that is now ready to process 30 million transactions in under 100 milliseconds. It's just not the requirement. However, does it mean that they won't have that requirement in the future? Absolutely not. And if some of their growth ambitions transpire, they want to be able to scale in that way. So that's where, ourselves, what we've managed to do is really position various tiered solutions for our customers to really start that journey at that, base point. But whilst doing that, still provide the level of automation, the level of integration that's required across other systems in the bank, etc., that provide the speed and delivery to the customer that's expected from a digital banking customer more than anywhere else, but is also making sure that they answer the risk question. So I'd say that it's not necessarily as true as it once was, where compliance is seen as just a cost. In that digital banking model, it absolutely can have an impact on the bottom line. If they're not able to do quick onboarding, if they're not able to do quick transactions, etc., they will lose that customer to potentially another digital bank or to another traditional bank who is, managing to disrupt and provide these kind of services themselves. So they see it as part of an important part of that growth journey, whilst also managing that risk as well.
Regulations in the area of digital banking are still evolving. What, according to you, are some of the areas that are likely to attract greater monitoring or scrutiny moving forward?
So regulations in the area of digital banking, yes, definitely still evolving. Which areas do I think are likely to attract greater monitoring or scrutiny going forward? Specifically to digital banking, first and foremost, as I've mentioned, there's definitely an application of some new technologies in this space. Techniques related to artificial intelligence, machine learning, some of those OCR capabilities, etc. I would say some of these new techniques would probably come under more regulatory supervision moving forward. For example, not all artificial intelligence use cases are necessarily ethical as things stand today. But on the flip side of that, quite interestingly, I also see, in speaking with the market, etc., some of those actual technologies and some of those techniques that might come under more regulatory supervision, they are actually also enabling to, provide much more efficient and effective supervision itself. So I think you'll see even more in the future, the regulators themselves will also start to utilize some of this technology, and that'll be for information sharing with one another, within market, across boundaries, but also more increasingly across across borders internationally to fight or combat financial crime in particular. Financial crime is definitely something which cuts across jurisdiction and international waters. What one thing could happen somewhere will impact another place, and money flows also a part of that. So I think that, whilst there will be more regulatory supervision on some of these techniques that are emerging, there will also be a more of an adoption even within those supervisors themselves to help make the more effective combating of financial crime moving forward as well. Obviously, the one that we can't miss being digital channels, digital banking. It's definitely a huge part of that is data. Who owns the data? Who owns my data? What interaction do I have with my own data, with my potential digital bank, etc. So, we've seen in the EU GDPR. A lot of us are familiar with that, even if we don't work in the EU. We might be in organisations like myself who have businesses in London and Europe, and we also feel the effects of GDPR in a positive way, right? This regulation in place is to really help provide that level of data protection and ownership, and help protect the consumer themselves, right, and understand more about how their data is being used, but in a positive way. It can also enable a better usage of data, and me understanding how and what I will allow and people to use my data for to provide me better services. So I really don't think it's out of the out of scope for things like GDPR in Europe to become more commonplace within the international community, and likely even to adopt a global regulation in a similar vein, especially as we see the acceleration of digital banking. In a space specific, very close to us in terms of the areas that we also help support and solutions we provide to our customers in the area. Transactions, payments, transactions, for sure, that's going to continue to have a lot of scrutiny. As I mentioned, there's an explosion of volume of digital payments globally. And that's going to only increase and only continue as a trend. So there's going to be even more scrutiny on that. We're seeing a lot of scrutiny if we move away from traditional remittance, even on trade or trade finance and some of the processes there, which include many counterparties. And there's a huge amount of sanctions risks involved in that, and a huge amount of money laundering risks as well also involved in that trade process. And that has already come under a much greater scrutiny over the last 10 plus years, and even OFAC recently, releasing some even new guidelines as well around that, and with big upgrades also in the area of maritime and vessel tracking and all these aspects that go into trade. So we're already seeing that scrutiny there, and I think that will continue with digital banking and crimes associated, financial crimes associated with that. And when it comes to transaction screening, a lot of focus has been on cross-border, as I mentioned previously, but more and more focus is coming on domestic. There are various camps within compliance professionals that would agree or not agree that sanction screening is required on domestic payments. Some might say that actually domestic screening is a bit superfluous. Because in certain markets they may say that they're already well equipped, with other financial institutions across the market, all actually doing robust onboarding at the first point that the customer actually gets onboarded, and those checks are already in place. So if they're in place, why would we also need to do an additional check at the actual transaction domestically? But things are growing in complexity, and sometimes, and we've seen with other banks, they've also said to us that it's not always easy even domestically to see where sometimes quickly where foreign entities, or entities are involved in a transaction, etc. So they continue to screen domestic payments as well. And regulators themselves, more and more in certain markets, are starting to talk about having more of a robust supervision on domestic screen as well. So yeah, there's a few areas there. and definitely data is a huge one of them. The technology techniques that are being implemented in supervision of those, greater supervision in the future, and also within existing areas that already has a lot of supervision, and will continue to do so.
Johnny, finally coming to the COVID-19 situation, have you seen any impact on digital banking or that side of the business due to the pandemic?
Have we seen any impact on digital banking from the COVID situation? Absolutely, 100% yes. I mean, look at myself and you, Shirish. I mean, we're doing this right now over an online conferencing platform. I won't name any names, but you know, I think COVID in the situation has been a massive impact across hundreds of types of businesses, thousands, millions of businesses. If you come back to a business that is already digitally focused and you talk about digital banking, I would say digital is here to stay, and it will be required more than ever. There's already been a huge adoption, there's already a huge acceleration. But COVID is merely, for me and for organizations that we work with in digital banking already in the region, and specifically as well, it's just simply put a rocket booster on the back of digital transformation, including in the space that they work in. We have customers here that are a fully digital bank in the region, and you know, right now they can actually have an account open within 5 minutes and potentially even credit lines within 30 minutes. In a situation like the situation that we're all in now globally, when you can't physically get to a branch, even if you normally bank with a traditional bank and usually do that approach of going to a branch still to do those more transactional affairs, that becomes extremely appealing, right? So I would say there's even a market there now where, you know, outside of the market that was already very much had an appetite for digital banking and looking to be customers of some of those new banks when they're coming online, or existing digital banks. There's also other areas or other sectors of the market that would maybe never have considered it, but suddenly are. I'll give you a funny example, quite anecdotal, which is indirectly linked, right? We have a tier one banking customer in Australia, and after the back of the COVID situation, and like many markets where there's been these physical lockdowns essentially, what they actually did was they called, I believe, over 30,000 customers to provide them education on digital banking, and that was within a focus on remote areas where, you know, some of these towns are typically within a couple of 100 kilometers of a main town where the bank branch normally sits, and this kind of population, typically that's classed as a suburbia. They're not so remote that they have to be on some kind of digital platform if they want to be banked in that way. But they were the type that would still now have passbooks, and they would travel into town, do their weekly trip to the bank, and go to the branch and do some of the transactions. So from what I understand from those 30,000 plus calls, where they started to educate some of those customers in those kind of profile areas, over 80%, about 10% of these customers actually ended up signing up for a debit card for the first time ever. And over 80% of those customers were actually over the age of 75. So we're seeing, you know, in that example there, I mean, it's a funny anecdotal example, and it's not a purely digital banking notion in how we're maybe talking today, but it just shows you, you know, that if a population in that way, in that age category, can suddenly be compelled to the first time in their life sign up to a debit card, it allows them to then have access to funds, services, products, without having to go to that physical branch. For me, it just really epitomizes how much, you know, acceleration and growth we're going to see in digital banking as a whole, across all age groups, across all types of profiles of potential customers. And look, in a world specifically, our world specifically, what we foresee is a willingness also to understand more on the back of the situation, and also then adopt some of the next gen screening capabilities that even we have. I think those conversations are definitely going to be accelerated even in some of the more traditional banking space. You know, and these are things that employ certain techniques that I mentioned earlier around machine learning techniques or artificial intelligence or advanced analytics, etc. These next gen, you know, technologies and screening capabilities that we have definitely are going to be more and more of interest to some of our customers to look to move towards and away from some of the more traditional rule-based approaches, because they're going to see a speed up, and I think they already are talking about this. They see a speed up in a transition to digital from the customer as well. And look, if these banks or other financial institutions don't adapt in that way and ensure that they are ready to provide this digital or more remote interaction with a customer and some of these more creative products and services and delivery of services, then they're going to lose big market share, and they're going to lose to some of these challenges, and that's definitely not a position they're going to be in or want to be in. So definitely I would just say that COVID, whilst it might slow down projects right now because of, you know, some of the limitations of being on lockdown, etc., it's just brought to the forefront and top of mind the importance of this digital strategy, the importance to pivot, even if they're not a digital organization as it stands, and the expectation of the customer more and more moving forward to have that in all of the services that they actually receive.
Johnny, thank you so much for sharing these insights with us, which I'm sure the FinTech community will find very, very interesting. Listeners, please join us again next Friday for the next Fridays with Fintelekt session. This is Shirish from Fintelekt signing out.